When I meet so-called financial experts today, most of them don't even remember 2008. They're so young, all they know is a bull market. All they know is that interest rates kept dropping, bond rates kept dropping, the price of stocks went up, real estate went up, everything was going up. We call it the everything bubble. And that's why I highly recommend this. There's only one newsletter, is the Wellington Report, because at least you'll have an idea of what's going on underneath the blankets. So be careful of the age of the person you take advice from, too.
Oh, that is such an important point. I wrote in the last issue of the Wellington letter, 3 things you want to look for in your advisor. And if he doesn't have all 3, find somebody else that does. The first thing is the experience. I said, at least 44 years of experience in the markets. That gets you back to 1978. Remember 1978 to 1981, because that is going to be replicated. I said, we're going to see the same thing. In 1978, we said, Treasury bond prices will decline by 40 to 50%. Again, that was called absurd. And it happened. They went down 44%. At this time around, I said, the inflation is going to exceed the level that we had in 1980. Okay, 1980 inflation was just hit. There was a 40-year high in inflation we have now. And we said the next target for inflation is going to be a new all-time high inflation, which would exceed the inflation level of 1917, which was 19.75%. So we're going to hit a new high in inflation. That means a new high in interest rates. A total disaster for bond prices. Bond prices are going to go down 70%.
I'm going to look confused here. So are you saying that we're in 2022 right now? Are you calling for inflation to go higher?
Yes.
And then how does that destroy bonds?
Because when interest rates rise, the bond prices decline proportionally.
Right. So, a bond is this. Let's say if a bond is paying 10% is worth so much money. But if the interest rates, if inflation goes to 20%, the value of the bond drops. And what most people do not realize, the bond market is 1 million times bigger than the stock market.
Exactly. It's much bigger.
And so that's why I listen to Bert all the time, because it's beyond my little meager brain. The point here is back when Bert and I were just starting out, there are exciting times. Are you saying it's going to get more exciting in 2022 and 23?
Yes, we have a special report, in fact, Bob, that we're offering people for free, because this is imperative that people know about this, that they don't believe all this stuff that you see and hear in the media. The big thing now is inflation.
So many of these idiots out there, there's no cure for stupidity, as you know, Bert. We've seen a lot of it over our times. But I have the 60-40 mix. It means they have 40% this and 60% bonds, and they're operating by these formulas that worked right after 2008. This ain't 2008.
Exactly. The world changes and they pretend it is static. How can you have a constant ratio of 60-40? That's absolutely ridiculous. You want to have a methodology that gets you out during a bear market. So if you don't see all of the signals that we see, doing this 12 hours a day, then at least you should have a simple, like a moving average. And so if it breaks through this, we're out.
Bert, you said there was 3 things. One was make sure your advisor is over 30 years old.
Yes, he should be at least 44 years in the business. Okay, if he's not, find someone else. The other thing is he should be very well versed in advanced technical analysis. Technical analysis gives you the change in money flow going into or out of an investment. And the third item is don't ever listen to anyone who manages money. That is my view. Anybody that manages money has such a deep conflict of interest. He cannot go into the media and become bearish, because half the people that he's managing money for would close their accounts.